As of this exact moment, Bitfarms Ltd is trading at a live intraday price of 3.67 Canadian dollars on the Toronto Stock Exchange. If you are watching the US listing on the Nasdaq, the ticker BITF is moving in correlation, but for the sake of precision in this analysis, we are anchoring our breakdown to the Canadian dollar figure as the primary reference point for this session. The market is currently digesting a complex mix of macroeconomic signals. Bitcoin is hovering near record highs, testing the psychological resilience of the $92,000 mark. Yet Bitfarms is not simply mirroring that price action in a 1-to-1 ratio. The stock is exhibiting a unique volatility profile today, oscillating within a tight intraday range as traders attempt to price in a future that is no longer just about hashing algorithms, but about energy infrastructure and corporate sovereignty. Expectations for Bitfarms have long been straightforward. You buy the stock as a high beta proxy for Bitcoin. The logic is simple. If Bitcoin goes up, the miner should go up more. That is the retail expectation. The reality, however, is far more nuanced and frankly more tense. The reality is that Bitfarms is currently the protagonist in a high-stakes corporate thriller involving hostile takeover attempts, massive fleet upgrades, and a strategic pivot that challenges the very identity of what a mining company is supposed to be. While the average investor checking their Robinhood app sees a chart that looks like it is lagging behind the crypto asset itself, the institutional eye sees a company in the middle of a metamorphosis. We are not just looking at a miner anymore. We are looking at a battleground for energy capacity in a world starved for power. The disconnect between the Bitcoin proxy expectation and the infrastructure play reality is where the opportunity and the risk lies. To understand the movement we are seeing on the tape today, we have to strip away the noise of the broader crypto market and look at the specific catalysts driving volume on BITF. The stock is reacting to a consolidation phase. After the explosive volatility surrounding the Riot Platforms takeover attempt and the subsequent settlement, the market is trying to find a fair value for Bitfarms as a standalone entity that is now aggressively expanding into the United States. When you look at the order flow today, you are seeing a tug-of-war between profit-taking from the recent run-up and accumulation by longer-term players who believe the acquisition of Stronghold Digital Mining is a mispriced asset. The Stronghold deal is not just a footprint expansion, it is a fundamental shift in how Bitfarms accesses power. By moving into the PJM interconnection in Pennsylvania, Bitfarms is trading the political uncertainty of Latin America for the regulatory stability, albeit higher cost, of the U.S. grid. This is what the market is trying to digest right now. Is the premium for U.S. energy worth the stability it buys? Let's talk about the volume. We are seeing elevated activity in the opening hours, which suggests that Fidelity Investments and other institutional desks are rebalancing their exposure to the mining sector. Unlike the retail crowd that might impulse buy based on a tweet or a green candle, these desks are looking at the hash price, the revenue a miner earns per unit of computing power. With Bitcoin network difficulty at all-time highs, the efficiency war is brutal. Bitfarms has been trading sideways to slightly up today because the market is cautiously optimistic about their fleet upgrade. They're swapping out older, less efficient machines for the T21 and S21 Pro models. This isn't just tech specs, this is survival. If you're holding Tesla stock because you believe in efficiency and engineering dominance, you need to apply that same lens here. Bitfarms is attempting to engineer its way out of the halving squeeze by drastically lowering the joules per terahash it expends. It is fascinating to observe how the sentiment on interactive brokers' trading forums and social channels shifts with every tick of the stock. There's a palpable anxiety among retail holders who have seen other miners like CleanSpark or Marathon diverge in performance. The frustration often stems from a lack of understanding regarding the dilution factor. To fund these massive upgrades and acquisitions, Bitfarms has had to issue shares. This creates immediate selling pressure that dampens the stock price even if the long-term value of the company is increasing. It's the classic tension between short-term pain and long-term gain. The market is currently punishing the stock for the dilution while ignoring the asset accumulation. This is the inefficiency that sophisticated traders look for. When you utilize Schwab Intelligent Portfolios or similar automated tools, they often miss these qualitative shifts. They see the share count go up and the EPS go down, but they miss the fact that the company just secured hundreds of megawatts of power capacity in a jurisdiction that is becoming the gold standard for compute. I want you to take a second and look at your own portfolio. Comment below how many shares of Bitfarms you currently hold, and more importantly, what your average entry price is. Are you underwater from the 2021 highs, or did you enter during the lows of the bear market? Your entry point likely dictates your sentiment right now. If you bought at the top, this consolidation is painful. If you bought at the bottom, this is just noise. Let me know in the comments. Moving deeper into the analysis, we have to address the AI elephant in the room. The narrative across the sector has shifted from pure mining to high-performance computing. You have seen companies like Core Scientific get re-rated by the market because they signed deals with hyperscalers to host AI chips. The expectation was that Bitfarms would announce a massive NVIDIA stock-style partnership immediately. The reality? They're taking a more measured approach. The Stronghold acquisition gives them the potential for HPC, but they haven't pivoted the entire ship yet. This hesitation is keeping a lid on the stock price. Investors want the AI premium now. But Bitfarms management knows that retrofitting a mining facility for AI is capital-intensive and technically difficult. They are choosing to remain a Bitcoin-first company for now, while securing the optionality for AI later. This discipline is rare, but in a market that rewards hype, it can feel like a penalty. Let's examine the geopolitical angle, which is often overlooked by those using basic investing sites for their research. A significant portion of Bitfarms' legacy operations has been in Quebec, Canada, and across Latin America, specifically Argentina and Paraguay. The news of selling the Yguazu facility in Paraguay to Hive Digital for roughly $56 million was a pivotal moment. On the surface, selling a power asset during a bull market seems counterintuitive. Why sell your capacity? The deeper reality is that Bitfarms is recycling capital. They realized that the capital expenditure required to finish Yguazu was too high relative to the opportunity cost of not expanding in the USA. They took the cash and they are deploying it into Pennsylvania. This is a masterclass in capital allocation, but it requires shareholders to trust that the U.S. strategy will yield better margins than the low-cost hydropower of Paraguay. It's a bet on jurisdiction over cost. It's a bet that U.S. energy, while more expensive, comes with better financing options and higher exit multiples. Now consider the macro environment. We are in a phase where online investment platforms are seeing a surge in new accounts, driven by the crypto resurgence. However, the interest rates set by the Federal Reserve act as gravity on these capital-intensive stocks. Bitfarms carries debt, and it requires constant capital to upgrade machines. If rates stay higher for longer, the cost of that capital remains a burden. However, Bitfarms has been aggressively paying down debt and restructuring its balance sheet. The company that exists today is fundamentally healthier than the one that existed in 2021. They have weathered the crypto winter, they have fought off a hostile takeover, and they have refreshed their leadership. This is a battle-hardened company. When you compare Bitfarms to its peers on a SoFi Invest dashboard, you'll notice that its valuation multiples often trade at a discount to the larger players like Riot or Marathon. This discount is the uncertainty gap. The market hates uncertainty, and the governance battle with Riot injected a massive dose of it into the stock. Now that the dust is settled, that gap should theoretically close. If Bitfarms can execute on their exahash targets, aiming for over 21 EH/s in the near future, the stock is mathematically undervalued relative to its production potential. They are mining Bitcoin at a direct cost that is still profitable even post-halving, but their corporate overhead has been the drag. As they scale up, that overhead becomes a smaller percentage of revenue, leading to operating leverage. That is the J-curve investors are waiting for. Let's step back and look at the business model for those who might be new to self-investing in this sector. Bitfarms is essentially an energy arbitrage company. They buy electricity at a fixed, low rate, run it through specialized ASIC computers, and generate Bitcoin, which is a variable-priced asset. Their profit is the spread between the cost of power and the price of Bitcoin. It sounds simple, but the execution is incredibly complex. They have to manage heat, hardware failures, firmware updates, and treasury management. Do they hold the Bitcoin they mine, HODL, or do they sell it to pay bills? Bitfarms has historically been more pragmatic than the never-sell maxis. They sell a portion of production to fund growth, which prevents them from having to dilute shareholders as much as they otherwise would. This is a prudent strategy, even if it annoys the ideological purists. The recent operational updates from November 2024 have been critical. The company reported a hash rate of around 11.9 EH/s in Q3, but the guidance and the installed fleet point to a rapid acceleration. The upgrade to S21 Pros is not just a minor bump. It improves efficiency by double-digit percentages. In mining, efficiency is everything. If Bitcoin price drops, the inefficient miners